Here is a number that should bother you. According to a 2023 TIAA Institute survey, only 19% of American adults could correctly answer basic questions about how compound interest works. And compound interest is the single mechanism that determines whether you end up with money or without it. Not the stock market, not your salary, not even your spending habits. One mechanism, and 4 out of 5 people walk into adulthood without understanding it. The school system had 12 years with you. 12 years of geography, literature, and the Pythagorean theorem. And somehow, the rules that govern every financial decision you will ever make never made it onto the curriculum. That is not an accident. It is a design. The way money actually works, how it is created, how it moves, who it rewards, and why, was never meant to be common knowledge. And the gap between what most people believe about money and what is actually true is wide enough to explain almost every financial mistake that gets made at scale. This video is about closing that gap, not with motivation, with the actual mechanics. The first thing most people get wrong about money is what it actually is, not in a philosophical sense, in a mechanical one. Ask anyone on the street, and you will get some version of the same answer. Money is a store of value, a medium of exchange, something the government prints and backs with real assets. That answer was true once. It has not been accurate since August 15, 1971, when President Nixon appeared on national television on a Sunday evening and announced that the United States would end the convertibility of the dollar into gold, effectively dismantling the Bretton Woods system that had governed global finance since 1944. There was no congressional vote, no public referendum. The decision was made over a single weekend at Camp David by a small group of advisors, and the announcement was framed to the public as a temporary measure. It was not temporary. More than 50 years later, no currency in the world is backed by a fixed quantity of any physical commodity. Every major currency on Earth is what economists call fiat money, currency that has value because a government declares it does, and because enough people collectively behave as if that declaration is true. The moment you understand this, the entire architecture of the financial system begins to look different. Because if money is not backed by a fixed asset, the next question becomes unavoidable. Where does it actually come from? The answer is not what most people assume. The majority of money in circulation in a modern economy is not created by governments or central banks printing banknotes. It is created by commercial banks in the ordinary act of making loans. When a bank approves a mortgage of $400,000, it does not locate $400,000 sitting in a vault and hand it to the buyer. It creates $400,000 as a new deposit entry, money that did not exist before the loan agreement was signed. The Bank of England confirmed this explicitly in a 2014 research paper titled Money Creation in the Modern Economy, stating directly that commercial banks create new money each time they extend a loan. The Federal Reserve's own public educational materials describe the same mechanism. This is not a fringe economic theory. It is the documented operational reality of modern banking, and almost no one outside the profession is taught it explicitly. In 2020, the Federal Reserve reduced the reserve requirement for American banks to 0%, meaning banks are no longer legally required to hold any fraction of deposits before issuing new loans. The practical constraint on money creation is now capital adequacy ratios set by regulators, not reserves, which means the money supply is, in structural terms, limited primarily by the willingness of creditworthy borrowers to take on debt and the willingness of banks to issue it. If that sounds like an unstable foundation, it is because it requires a level of institutional coordination between the Federal Reserve, the Treasury, the banking system, and the collective confidence of market participants that most people never see and were never shown. The reason this is the correct starting point, and not a footnote buried in an economics course, is that it restructures the logic of almost every financial decision you will ever face. If most money in existence is debt, then the total money supply grows when people and institutions borrow more, and contracts when they repay. The economy, therefore, requires continuous net borrowing to sustain its current money supply. When borrowing slows, when consumers and businesses collectively pay down debt faster than they take on new debt, The money supply tightens, credit becomes scarce, demand drops, and the conditions for a recession are mathematically in place. This explains something that confuses most people: why central banks respond to downturns by cutting interest rates and encouraging more borrowing rather than rewarding saving. In a debt-based monetary system, saving without corresponding new borrowing elsewhere does not accumulate wealth at the macro level. It drains the money supply. The individual rational choice and the system-level requirement are pointing in opposite directions. That tension runs through almost every major personal finance question you will ever have to answer. And it begins with accepting that the money in your account is not a neutral object. It is a claim on future economic output, sustained by collective confidence, credible only as long as the institutions behind it remain so. What that means for the actual financial decisions you make, and why understanding it changes the math on almost every one of them, is what the next block examines. If money is created through debt, then the cost of debt is not just a personal finance variable. It is the control mechanism of the entire system. And the institution that sets that mechanism is the Federal Reserve. Most people understand the Fed only at the surface level. It raises or lowers interest rates, and that affects mortgage payments and credit card debt. That framing is accurate but incomplete to the point of being misleading. The Federal Reserve does not set the interest rate you pay on your mortgage directly. It sets the federal funds rate, the rate at which banks lend reserves to each other overnight. Everything else flows from that number through a transmission chain that most people never trace all the way through. When the Fed raises the federal funds rate, borrowing becomes more expensive across the system. Banks charge more for loans. Businesses that were planning to expand on credit scale back. Hiring slows, consumer spending contracts. Inflation, which is what the Fed is typically trying to suppress when it raises rates, begins to ease, but only after a lag of 12 to 18 months that the Fed itself acknowledges it cannot precisely predict. Jerome Powell stated this plainly in a 2022 press conference. Monetary policy operates with long and variable lags. The Fed is, in structural terms, steering a vehicle by looking at where it was rather than where it is going. The 2022 to 2023 rate hiking cycle illustrates this with unusual clarity. Between March 2022 and July 2023, the Fed raised the federal funds rate from near zero to a range of 5.25 to 5.5%, the fastest tightening cycle in 40 years. The stated goal was to bring inflation from its peak of 9.1% in June 2022 back toward the 2% target. By June 2023, inflation had fallen to 3%. The mechanism worked, but the collateral damage was significant. The regional banking crisis of March 2023, which led to the collapse of Silicon Valley Bank and Signature Bank, was directly connected to the rate environment. Both institutions held large quantities of long-duration bonds that lost market value as rates rose, creating the conditions for a classic bank run when depositors lost confidence. Higher rates, designed to cool inflation, simultaneously exposed fragilities in institutions that had loaded up on fixed-rate assets during the near-zero rate environment of 2020 and 2021. That is not a coincidence or a policy failure in isolation. It is the expected behavior of a system where the cost of money is artificially suppressed for an extended period and then rapidly normalized. The assets and business models that form during low-rate environments are calibrated to those conditions. When the cost of money rises, the mismatches become visible. What this means at the individual level is direct and often underappreciated. When rates are low, the math on borrowing to acquire assets, real estate, businesses, income-producing investments, is structurally favorable. Cash earns almost nothing. Debt is cheap. Assets financed with cheap debt appreciate. When rates are high, the math reverses. Cash earns a real return for the first time in years. The cost of leverage rises. Asset prices adjust downward to reflect the new cost of capital. People who understood this dynamic in 2020 and 2021 were not making better stock picks or finding better real estate deals. They were reading the rate environment correctly and positioning accordingly. People who did not understand it made decisions calibrated to a rate environment that no longer existed, and paid for it in 2022 and 2023. The rate cycle is not a background variable, it is the primary variable. And the Fed, an institution that most people interact with only as a name on a news headline, sets it through a mechanism that is publicly documented, publicly discussed, and almost universally misunderstood by the people most affected by its decisions. The next layer underneath that is equally important: understanding how the rate environment interacts with inflation, and specifically, why the number the government reports as inflation is not necessarily the number that reflects your actual financial reality. The official inflation number in the United States is the Consumer Price Index, published monthly by the Bureau of Labor Statistics. It is the most cited economic statistic in financial media, the benchmark the Federal Reserve uses to calibrate monetary policy, and the figure most people reference when they talk about the cost of living rising. It is also a measure that systematically understates the inflation experienced by a large portion of the American population, not because of fraud or deliberate manipulation, but because of how it is constructed and what it is actually designed to measure. The CPI tracks the price of a fixed basket of goods and services meant to represent the spending patterns of a typical urban consumer. Housing costs, the single largest expense for most households, are represented in the CPI not by actual home prices or even current market rents, but by a metric called owner's equivalent rent, a survey-based estimate of what homeowners think they could rent their home for. In January 2022, when the housing market was running at its most aggressive pace in decades, the OER component of the CPI was rising at roughly 4% annually. Actual rents in major markets were rising at 15 to 20%. The lag between real market conditions and what the CPI captures in housing costs is not a minor rounding error. It is a structural feature of the index that consistently dampens the reported number relative to what renters and recent homebuyers actually experienced. Healthcare costs present a similar distortion. The CPI measures out-of-pocket healthcare spending, not the total cost of healthcare, which means that as employer-sponsored insurance absorbed more of the cost increase, the CPI component for healthcare appeared to moderate, even as the actual economic burden on households rose. This is not an argument that the CPI is useless. It is a useful index for what it measures. The problem is that what it measures and what most people assume it measures are not the same thing. When the Fed says inflation is under control because the CPI is at 2.5%, it is making a statement about a specific statistical construct, not about whether your grocery bill, your rent, or your healthcare premium feels manageable. The divergence between measured inflation and experienced inflation has been particularly acute for households in the bottom two income quintiles. A 2021 analysis by the Roosevelt Institute found that lower-income households spend a disproportionately higher share of their income on food, energy, and shelter, the categories that experienced the sharpest price increases between 2020 and 2023. A 2% average inflation rate can coexist with a 10% effective inflation rate for a household that spends 60% of its income on rent, utilities, and groceries. The average hides the distribution. There is a second inflation number that receives less public attention, but is arguably more relevant to long-term financial planning: asset price inflation. Between 2010 and 2020, the S&P 500 returned approximately 13.6% annually. U.S. residential real estate in major metropolitan areas appreciated at rates between 5 and 9% per year. Meanwhile, the CPI averaged roughly 1.8% annually over the same period. The official inflation measure said prices were essentially stable. The price of owning a home in a major city or building a meaningful investment portfolio was rising at multiples of the reported inflation rate. People who held assets during that decade accumulated wealth. People who held cash, believing that low measured inflation meant their purchasing power was safe, watched the real cost of financial security rise faster than their savings. Understanding this distinction between consumer price inflation and asset price inflation is not an academic exercise. It is the practical explanation for why two households with identical incomes in 2010 could arrive at 2020 in dramatically different financial positions, depending entirely on whether they held assets or held cash. The implication for what you do with money is direct. In an environment where the cost of financial security compounds faster than the purchasing power of uninvested cash, not investing is not a neutral choice. It is a choice with a cost that never appears on any statement but accumulates with the same consistency as any other compounding force. What that cost looks like in concrete numbers, and what it reveals about the real return on the most common financial decisions most people make, is the next layer. The most expensive financial decision most Americans make is not a bad investment or a high-interest debt. It is waiting. Specifically, the decision to delay investing, whether by a few years while paying off student loans first, or a decade while building an emergency fund to a threshold that keeps expanding, or indefinitely while waiting for a market moment that feels less uncertain than the current one. The cost of that delay is not abstract. It is calculable, and the numbers are large enough that most people, when confronted with them directly, do not believe they are accurate. Consider two people with identical incomes, identical savings rates, and identical investment returns. The first begins investing $400 per month at age 25, continues until age 35, and then stops entirely, contributing nothing for the remaining 30 years of their working life. The second waits until age 35 to begin, then invests $400 per month continuously until age 65. Both invest for exactly 10 years of active contributions. At a 7% average annual return, the approximate inflation-adjusted historical average of a broad U.S. stock market index fund, the person who started at 25 and stopped at 35 ends with approximately $602,000 at age 65. The person who started at 35 and contributed for 30 uninterrupted years ends with approximately $486,000. The person who contributed for a decade and quit 30 years earlier ends with more money than the person who contributed 3 times as long. The mechanism producing this outcome is not financial wizardry. It is the mathematical property of exponential growth applied over time. The earlier investor's money had 40 years to compound. The later investor's money had 30. That 10-year difference in starting point, not the amount contributed, not the investment selection, not the timing of market cycles, is what determines the final outcome. This is the practical meaning of what the TIAA Institute survey was measuring when it found that only 19% of American adults understood compound interest. Not whether they could recite the definition, whether they understood it well enough to have internalized its implications for their own behavior. The same mathematical principle that makes early investing so powerful makes high-interest debt so destructive. A credit card balance of $8,000 at 24% annual interest with minimum monthly payments will take approximately 27 years to pay off and will cost the borrower roughly $14,000 in interest, nearly doubling the original balance. The Federal Reserve's 2023 survey of consumer finances found that among American households carrying credit card debt, the median balance was $2,700 and the average was $6,500. Approximately 45% of all American households carried a credit card balance in 2023, meaning nearly half the population was paying compound interest rather than earning it. The asymmetry is stark. Compound interest working in your favor over 40 years produces wealth that feels almost implausible. Compound interest working against you over 27 years produces a debt burden that is equally implausible and equally real. What makes this particularly consequential is that the financial decisions which determine which side of this equation you occupy are almost never framed in terms of their compounding cost. A car loan is presented as a monthly payment, not as a total interest burden or an opportunity cost. A credit card minimum payment is presented as a convenience, not as the slowest and most expensive possible path to a zero balance. A savings account earning 0.5% annual interest is presented as a safe place to keep money, not as a vehicle that loses real purchasing power in any environment where inflation exceeds that return, which has been true for most of the past decade. The financial products most aggressively marketed to ordinary consumers are, in nearly every case, the ones most beneficial to the institutions selling them. That is not a conspiracy. It is the predictable outcome of a system where financial literacy is not a public priority and product marketing budgets are. The practical question, which most people are never helped to answer clearly, is not which financial product to choose. It is which financial behavior, compounded over time, produces the outcome you actually want. And the answer to that question depends on understanding something that the default financial education most people receive consistently fails to address: the difference between income and wealth, and why confusing the two is the central financial mistake of the American middle class. The distinction between income and wealth is one of the most consequential ideas in personal finance and one of the least taught. Most people use the terms interchangeably, as if a high income and financial security were the same thing. The data suggests otherwise. A 2019 study published in the journal Social Forces analyzed decades of earnings and asset data and found that income rank and wealth rank diverge significantly across the American population, meaning that high earners are not reliably high-wealth individuals, and that the path from earning money to owning assets is neither automatic nor guaranteed. The clearest illustration of this divergence is what economists call the consumption trap. As household income rises, consumption tends to rise at roughly the same rate, a phenomenon described by economist James Dusenberry in 1949 as the relative income hypothesis and confirmed repeatedly in subsequent research. People do not save more as they earn more in any reliable, proportional way. They spend more. A household earning $120,000 per year is not, on average, saving 3 times as much as a household earning $40,000 per year. It is typically spending 3 times as much on housing, transportation, dining, travel, and the category of expenditure that behavioral economists have documented most thoroughly: status maintenance. The psychological mechanism behind this pattern is not a character flaw. It is a documented feature of human cognition. People assess their financial position not in absolute terms, but relative to the people around them. When income rises, the reference group shifts. The comparisons change. The baseline for what constitutes a normal level of consumption recalibrates upward. The result is that income growth, without a deliberate and specific intervention in spending behavior, tends to produce lifestyle expansion rather than asset accumulation. This is the mechanism behind what is sometimes called lifestyle inflation, and it explains why a significant portion of American households earning above the median income report feeling financially insecure. A 2023 Bankrate survey found that 52% of Americans earning between $100,000 and $150,000 per year described themselves as living paycheck to paycheck. Not because $100,000 is insufficient income to build financial security, because income without a structural saving and investing mechanism attached to it does not automatically convert into wealth. The households that build wealth on middle incomes and the households that fail to build wealth on high incomes are not separated primarily by intelligence, discipline, or financial sophistication. They are separated by structure. Specifically, by whether the saving and investing behavior happens automatically before discretionary spending decisions are made, or whether it depends on willpower applied to whatever is left over at the end of the month. The behavioral finance literature on this point is unambiguous. Richard Thaler and Shlomo Benartzi's 2004 research on the Save More Tomorrow program demonstrated that automatically escalating contribution rates, a structural intervention that required no ongoing willpower, increased savings rates among participants from an average of 3.5% to 13.6% over 40 months. The behavior did not change because people became more disciplined. It changed because the structure changed. The practical implication is direct. The most reliable predictor of whether income converts to wealth is not the amount of income, but the architecture of what happens to it immediately after it arrives. Households that automate investment contributions before discretionary spending, through payroll deductions into a 401k, automatic transfers to a brokerage account, or any mechanism that removes the money from the spending pool before a spending decision can be made, build wealth with a consistency that households relying on end-of-month surplus do not. This is not motivational advice. It is a structural observation about the difference between a system that produces wealth as a byproduct and a system that requires willpower to produce it at all. Systems that require willpower fail under stress. Systems that produce wealth automatically continue to function regardless of how difficult the month was. The question this raises, and it is the question that connects everything in this video to a single coherent framework, is why, if the mechanism is this well documented and this accessible, so few people implement it. The answer involves something that almost no personal finance content addresses directly: the role that institutional incentives play in shaping the financial behaviors of ordinary people, and why the system as it currently operates is not designed to close the gap between what people know and what they do. The gap between what people know about personal finance and what they actually do with their money is not primarily a knowledge problem. It is an incentive problem, and the incentives are not aligned in the direction most people assume. The financial services industry in the United States manages approximately $30 trillion in retail assets. It generates revenue primarily through fees, commissions, and interest charges. The mathematical relationship between those revenue streams and the financial outcomes of clients is, in most product categories, inverse. The more a financial product costs the consumer, the more revenue it generates for the institution selling it. This is not a hidden fact. It is the documented structure of the industry, and it produces predictable outcomes at scale. The mutual fund industry offers the clearest example. In 2023, the average expense ratio for actively managed equity mutual funds in the United States was approximately 0.66% annually, according to Morningstar. The average expense ratio for passive index funds tracking the same markets was approximately 0.05%. The fee difference of 0.61% per year appears small. Applied to a $200,000 portfolio over 30 years at a 7% gross return, it produces a final balance difference of approximately $92,000, the equivalent of several years of contributions, paid not to the investor, but to the fund manager. The performance data makes this more striking. S&P Global's ESPIVA report, which tracks active fund performance against benchmarks on a consistent basis, found that over the 15-year period ending December 2023, approximately 88% of actively managed large-cap U.S. equity funds underperformed the S&P 500 index after fees. The product that costs more delivers worse results in the large majority of cases over long time horizons. It remains the default recommendation of a significant portion of financial advisors and the dominant product in many employer-sponsored retirement plans. The reason is not that financial advisors are uniformly acting in bad faith. The reason is that the compensation structure of the industry, built primarily on commissions and asset-based fees rather than flat advisory fees or outcomes, creates systematic pressure to recommend products that generate revenue rather than products that optimize investor outcomes. The fiduciary standard, which legally requires advisors to act in the client's best interest, applies only to a subset of financial professionals. The suitability standard, which requires only that a recommendation be suitable, not optimal, governs the rest. The distinction is consequential. A product that charges 1.2% annually and underperforms a 0.05% index fund can still be suitable. It cannot be fiduciary. Most retail investors do not know which standard their advisor operates under, and most do not know to ask. The insurance industry operates on a parallel structure. Whole life insurance policies, which combine a death benefit with a savings component, are among the highest commission products in the financial services industry. The internal rate of return on the savings component of a whole life policy typically runs between 1 and 3% in the early decades of the policy. The S&P 500, over any 30-year rolling period in the past century, has never produced a negative return. The comparison is not complicated. The sales volume of whole life insurance products, despite this comparison, remains substantial. Because the commission paid to the selling agent on a whole life policy is significantly higher than the commission on a term life policy paired with a separate investment account. What the consumer pays and what the consumer receives are two separate calculations. The industry optimizes for the first. The system is not designed to be adversarial. It is designed to generate profit. But in a market where financial literacy is low, where product complexity is high, and where the regulatory framework establishes a floor of suitability rather than a ceiling of optimization, the predictable outcome is that ordinary people systematically end up in financial products that serve institutional interests more reliably than their own. The logical response to this is not cynicism and paralysis. It is a specific set of structural choices about which products to use, which professionals to engage, and on what terms, that remove as much institutional friction from the path between your income and your actual financial security as possible. Those choices are simpler than the industry's complexity suggests, and they connect directly to the question that opened this video: why nobody taught you this, and what changes when you finally understand it. The question this video started with was not rhetorical. Why nobody taught you how money works is a question with a specific, documentable answer. And that answer matters because it determines whether the gap in your financial knowledge feels like a personal failure or what it actually is, a structural outcome. The formal education system in the United States does not require personal finance instruction as a condition of graduation in the majority of states. As of 2024, only 25 states mandated a standalone personal finance course in high school. The other 25 produced graduates with no formal exposure to compound interest, tax-advantaged accounts, debt mechanics, or investment principles, the operational knowledge that determines financial outcomes for the next 50 years of their lives. This is not an oversight. The curriculum decisions made at the state and district level reflect priorities, and financial literacy has not historically ranked among them. The financial services industry, which would benefit most from a less informed consumer base, has not lobbied aggressively to change this. The result is a population that enters adulthood financially illiterate by design, then encounters a financial system optimized to monetize that illiteracy. What this video has tried to do is compress the foundational layer of that system into a single coherent picture. Money is not a neutral object backed by physical assets. It is a debt-based construct sustained by institutional confidence and collective behavior. The cost of money is set by a central bank operating with acknowledged imprecision, transmitting policy through a chain of mechanisms most people never trace. The official measure of inflation is a statistical construct that captures some price changes accurately and others poorly, and consistently understates the cost of accessing financial security through assets. Compound interest is the dominant force in personal financial outcomes, and whether it works for you or against you is determined almost entirely by decisions made in the first decade of your adult life. The gap between income and wealth is not a function of earnings, but of structure, of whether saving and investing happen automatically or depend on willpower applied to what remains after spending. And the financial products most visible and most aggressively marketed to ordinary people are, systematically, the ones that generate the most revenue for institutions and the least return for the people holding them. None of this is complicated once it is stated plainly. All of it is consequential. The practical synthesis is this: a household that understands these mechanics, that treats money creation as a system to navigate rather than a background fact, that reads the rate environment as the primary variable it is, that accounts for asset price inflation rather than just consumer price inflation, that automates investment before discretionary spending rather than after, and that selects financial products by their cost, adjusted long-term return, rather than their marketing. That household is not doing something exotic. It is applying the basic operational logic of the system to its own advantage, rather than allowing the system to apply it in reverse. The knowledge required to do this is not graduate-level economics. It is the knowledge covered in this video. The knowledge that was withheld from most people not through malice, but through a combination of institutional inertia, misaligned incentives, and a curriculum that treated the Pythagorean theorem as essential and compound interest as optional. The gap closes when you understand the system. and understanding the system begins with accepting that it was never designed to explain itself to you. If you've made it this far with me, I want to invite you to subscribe to our channel and follow along every day. If this video shifted something in how you think about money, share it with 5 people, not because the algorithm rewards it, but because the knowledge in it is the kind that changes outcomes, and most people in your life were never taught it either. Leave a comment with what surprised you most, or with the financial topic you most want covered next. The most useful thing you can do with what you learned here is not keep it to yourself.